I don't think we can say that if one side wins, inflation is going to suddenly go down.
Hmm.
So, high debt, lower interest rates, stubborn inflation, that the scenario, at least for the next 12 months, is going to be pretty similar for gold and silver, whoever wins. The bigger differences will come on the economy generally and on some of the other resources. So Trump, for example, has made several times, he said, drill, baby, drill.
You're watching Capital Cosm. My name is Danny, and today's guest is the one and only Adrian Day. Adrian, thank you for making your third visit here on Capital Cosm. Much
Well,
appreciated.
thank you for asking me, the one and only Danny.
Yeah. Oh, well, let's just kick off with your thoughts on the markets, the economy in general. What is top of mind for you? What is occupying your headspace right now, Adrian?
Well, what's top of mind for me is gold, but maybe we'll get to gold in a second. Yeah, I mean, I'm very concerned. I think the U.S. economy is a lot weaker than the headline reports would suggest, for a lot of reasons. But we can delve into if you want. But I just think the economy is weaker than the headlines suggest, and then it's particularly weaker. It's a very bifurcated economy down here. So the lower 40-50% by household, by income, that group, which is half the country, is really hurting right now. You can look at credit card debt balances, credit card defaults, automobile loan defaults, etc. So I think the U.S. economy is weaker than it appears. I think China's economy is also weak. And it's weak not just cyclically, but structurally as well. They can do a lot of things to fix some of that, the stimulus programs they've got. But they also have structural problems, primarily demographics. So that's the first thing. The economies of the world are not as strong as they might appear, and they're getting weaker, in my view. At the same time, inflation is not by any means, what's the right word, conquered. So you look at the US, for example, you look at the Fed's own preferred measure, which is the core PCE for people who don't eat and don't heat their homes or drive anywhere. But the core PCE has come down a lot, of course. But you look at the last 5 months, and it's been kind of stable, 2.6, 2.8, 2.7, 2.6, 2.7. Number one. Number two, that's significantly above pre-COVID. And number three, of course, it's significantly above the Fed's own target. So as they start to lower rates, there's no indication that inflation numbers will continue to go down. And I'm speaking with English understatement here. I think they're going to go up, but there's no suggestion that they'll continue to come down as the Fed starts cutting rates. So you've got that combination of a slowing economy, a sluggish economy at best, with stubborn inflation at best. And that's not a good environment. Now, on the markets, just because something is expensive, obviously doesn't mean that it's going to turn around anytime soon. But it's an indication of how much risk is in the economy. So in the market. So you look at the U.S. stock market, and valuations are excessively high. Breadth is very, very narrow. We've started to have trouble with some of the Magnificent Seven, or were the leaders of the last year. You look at Microsoft, or Tesla, of course, went down and came back. But Microsoft, NVIDIA just recently. So we're starting to see that these Magnificent Seven are not a one-way street. But at the same time, you've got a significant number of new lows. It changes every week, well, every day, but the numbers change. But a significant number of new lows relative to new highs, which you shouldn't be seeing if the market is moving up and really strong. So breadth is low. So what I'm saying is there's a lot of risk in the stock market. And then, there are some undervalued markets, but the markets that are undervalued, like Hong Kong, China, or China, Hong Kong, are definitely undervalued for a reason. So we are looking at stocks, but we're looking very, very selectively and what's the word, opportunistically. So I think some British stocks are attractive right now, particularly if they're exporters. We're buying some Singapore stocks, some Japanese stocks, but it's all very, very selective and opportunistic, frankly. So I don't know if that we haven't got to gold yet, but that's how I'm seeing things generally.
Yeah, we can tie in gold to your analysis there, Adrian. One of my good friends, Kevin, from North Star Bat Charts, he showed an analysis where he looked at the CPI, the PPI, the M2 money supply, even the S&P, and all of those indicators were breaking down versus gold. So
Yeah,
yeah, so the market may be making new all-time highs, but if you price it in gold, it's a different story. The CPI is breaking down versus gold. The PPI is breaking down versus gold. M2 money supply is breaking down versus gold. So what does that mean exactly, in your opinion?
yeah. Well, gold's really interesting, as you say. We're at new all-time highs, and the gold stocks have moved significantly. Um, And it looks like we might be getting today. We might be finally getting that pullback, but a lot of people, including myself, have been suggesting, we're overdue for a pullback, no question about that. And to be honest with you, if this pullback lasts another week and takes us down another, 5 or 10%, that's not going to concern me. That would be kind of normal after the big run we've had. More fundamentally, if you step back a bit, I mean, everything is finally turning in gold's favor. So for the last 2 years, we've had a strong gold market, but the strong gold market was based on what we'll call unusual buying, and therefore for unusual reasons. So central banks, for example, obviously everybody knows central banks were the main buyers of gold over the last 2 years, but central banks were buying because of weaponization of the dollar and their desire to diversify their foreign exchange away from dollar dominance. Um, that had very little impact, or that had nothing, that was irrelevant for the individual investor sitting in the US. Those factors didn't come into play. Similarly, Chinese buyers were very, very heavy into gold, starting at the beginning of this year. And that was, concern over their economy, concern over the possible devaluation or decline in the purchasing power of yuan, renminbi. They didn't want to put money in the banks because the banking system in China is a little bit uncertain, shall we say. They didn't want to buy real estate for reasons we don't have to go into. They didn't want to buy Chinese stocks because up until the last couple of months, Chinese stocks had just been in a straight line down for the last 2 years. They're not allowed to buy crypto, and so what was left was gold, right? Again, those factors didn't really have anything to do with the US or, for that matter, the European investor. It's only been in the last month, really, when the Fed started cutting rates, that, and other central banks around the world, of course, are cutting rates, but the Fed being in charge of the largest economy, when they cut rates, it's only then that what I call the traditional factors that make gold attractive to investors started to turn in our favor. So you have interest rates coming down before inflation is conquered. You have clearer signs, shall we say, that the economy is slowing, which means that those rate cuts will continue. And you have a dollar that is certainly not collapsing, but certainly not particularly strong. And so those factors now moving in favor, those factors are now making gold more attractive, which is why now we've finally started to see Western buyers, US, Canada, Europe, why we've now started seeing those buyers turn towards gold. Still nowhere near a flood of money pouring in, but certainly the dynamics have changed considerably over what they were in the spring and early summer, when funds, both mutual funds and the ETFs, were getting consistent and steady outflows. Now we're seeing net inflows, still not dramatic, but we're seeing net inflows. So
Who
yeah, so I think the background is that the what we've seen for the last 2 years, if you like, is the overture, if you think in opera terms, and the curtain has now just risen on the actual production.
I
So I think we're right at the beginning
I see.
of yeah.
No, who are these Western buyers that you alluded to?
Well, so if you go back, say, 6 months, the people who were buying would be very, very few, but very, very wealthy families, primarily families and individuals who were buying. People like Bill Druckenmiller, and that was clear from the filings. And at the same time, the ETFs, both the GLD and the GDX, were seeing net outflows and significant outflows. What's changed in the last few months is the inflows, and that would be just general investors. I mean, you're getting inflows into the GLD, you're getting inflows into the GDX, and these would be family offices. At the last two big mining conferences in Denver, there were a lot more generalist investors, so family offices, than there had been, say, the last year. You're still not seeing. So these would be a few family offices and smaller institutions that are attracted to gold. Most of it is still individual investors. The larger institutions, the larger funds are still by and large not attracted to gold. So I've said this before, I may have said it on this show, and I apologize if I'm repeating, but when I first came into the business, 40, 50 years ago, all the way up until about 2011, 12, at the peak for gold, you could look at any mutual fund you wanted to, a US big cap, a global value, an emerging growth, whatever you wanted to look at. Every single fund pretty much had some gold exposure. It might just be gold bullion, or it might be one or two stocks, but they all had gold exposure. In the last 5 years, and even today, you look at, just pick half a dozen funds at random, and none of them has gold. None of them. Other than dedicated gold funds or resource funds. That's going to change. I think that'll change, but that sort of thing takes time to change. So we're not seeing any inflows from big institutions. We're only seeing it, I think, from a handful of, family offices, maybe small pension funds, but maybe have bought gold in the past. But I've got to think, when you see something, and we're seeing more press attention as well, and of course that's what drives investment. You're seeing gold talked about a little bit more as it continues to make new highs. I mean, it's astonishing to me that if you go back to May, June, July, yes, it was making new highs, but no one was talking about it in the
Mm-hmm.
media. You could ask 100 investors, and I bet you not one in 100 would know that gold has outperformed the S&P for the last 3 years. But gold has outperformed the S&P for this century, since 2000. Probably one in 100 knows that the XAU has outperformed the S&P for the last 6 months, for the year to date, for the last year. So that performance eventually starts to get people's attention, and when it starts to get people's attention, then people start to invest.
Yeah, you're starting to see these cracks form on the wall. The big question, however, is when does the wall break? When does the dam break? I.e., when do more institutional investors come in? When does retail finally get a clue and wake up?
Yeah, I mean, I think it's more on a continuum. Obviously, it's one thing at a time. I mean, higher prices do it. I frankly think that three back-to-back quarters of higher cash flow for the gold mining stocks will do it. Now, Newmont really let the team down with their earnings, and they're, of course, the largest gold mining company. But you look at Agnico today, I mean, once again, they hit the ball out of the park. And let's face it, when you've got higher gold prices and you've got lower oil prices, oil being the number one cost input for mines, we should be seeing
Yep.
higher margins. We should be seeing better cash flow and free cash flow. That's what we saw from Agnico. And I suspect that when more and more of the companies do report, Newmont led the side down, as I said. Barrick will have to wait on the costs because they have not pre-released their costs. They pre-released production, which was not very good, and that's not a good indicator of costs because, of course, the more ounces you produce, then the lower your per ounce cost is, other things being equal. But I think some of the other companies are going to have good quarters. But you look at the first two quarters, the first half of the year, the gold mining sector has had the highest cash flow per share growth of any sector out there. Again, people don't know that. But if you get three back-to-back quarters where the gold mining space has rising cash flow, I think people have got to start to notice at some point, haven't they?
Yeah.
Especially if the Magnificent Seven start to, wobble a little bit. People have got to start looking at, well, what's cheap out there? What's doing well and what's still cheap?
Hey guys, quick pause. I won't take too much of your time, but if you're looking to add into your gold and silver stack, please consider Miles Franklin. More specifically, email them, info@milesfranklin.com, and tell them that Capital Cosmos sent you in the subject line to unlock special pricing that you won't find on the website. In the unlikely event that you don't like the prices, you could always not buy. There's no commitment necessary, but I do recommend Miles Franklin for a number of reasons. The customer support is top notch, the prices are great, and I know the people there. Great people all around. So with all that said, let's get back to the video. Thanks, guys. It might have to take a complete wipeout of the broad market for people to wake up and to elicit the next rotation. Don't you think?
Yeah. Sorry, you said a wipeout of the broad market?
Mm-hmm.
Yeah, well, of course, we don't necessarily want that because if the broad stock market falls sharply, then you're going to get gold stocks down as well. That's always the case.
Yeah.
You have
Well,
a slow, sorry?
no, you can go ahead and finish. I didn't mean to
I was
interrupt.
just going to say, if your broad stock market decline is slower and more in the sense of rotation, then the gold stocks don't necessarily, or other stocks like oil stocks, don't necessarily have to fall. But if it's a sharp decline, you're going
Yeah.
to get everything falling.
Yep. And that's because of the margin calls, right?
Yeah, yeah,
Well,
yeah.
what about silver? How does silver look throughout all this?
Yeah, well, silver. I mean, silver is a monetary metal, obviously, and it tends to act up and down like a monetary metal. I mean, if you chart gold and silver, even in the last couple of years when there's been such, I was going to use the word hype. I don't mean to be that's got a negative connotation. I don't mean that, but even when there's so much focus, that's a better word, on solar panels and the increased use of silver, but even with that, silver's general direction still moves with gold like a monetary metal. But of course, as we all know, those moves tend to be exaggerated, and they tend to be exaggerated both because it's a smaller market. You've got demand rather, a large amount of retail and speculative demand, which can which can drive prices faster than for gold. And you've also got on the supply side, you've got at most 30% of silver production is from primary silver mines. Most of it is byproduct, and most of that byproduct, and this is different from gold, it's also different from the silver market 30 and 40 years ago, when most of the silver was from primary mines. Now it's mostly from byproduct, and the byproduct is not 49% of a 51% gold mine. It's 10% or 8% of a zinc mine, of a lead mine. Well, the zinc miner in Peru doesn't respond to changes in the price of silver because silver is only a small part of his production. He may well have hedged that silver byproduct in any event. So, so silver's production does not increase or decrease, for that matter, in response to changes in the price of silver. And that's another reason why you get these big moves in silver, because the production, the supply, and the supply of silver comes primarily from production, unlike gold with huge amounts of above ground supplies. Um, the supply of silver comes primarily from production, and production does not change in response to changes in the price of silver. So yeah, so silver will move in the same direction as gold, but the moves can be much, much more leveraged, more spectacular, which is what we've seen this year, of course.
Understood. What do you make of this BRICS summit that
And
we've?
what we're seeing today, by the way. It works both ways.
Mm-hmm. Yeah.
Sorry.
No, I was just gonna say, what do you think of the BRICS summit that occurred last week? What does that portend to gold?
Um, it's all moving. I think a lot of people expect too much too soon from the BRICS, from the replacement of the dollar as a reserve currency, etc. They expect too much too soon. Um, it's clearly all moving in a direction that is favorable to gold, but these things take time. And of course, when we talk about the dollar as a reserve currency, we've got to think of two different things. One is, the gold is the dominant currency for use in global trade. And the other one is the dollar's position in foreign reserves, in reserves of governments and central banks. They're two distinct sides of they're two distinct things, but they're both part of the of being the world's reserve currency. Now, in both of those, as a trading currency and as a reserve currency, the dollar's position has gone down meaningfully, not just over the last couple of years, since central banks started to get worried about weaponization of the dollar and since the BRICS was formed, but really over the last several decades. Look at the dollar as a percent of world central banks' foreign reserves. That is, all reserves that a central bank holds other than those of its own currency, right? And back in 1990, that was about 80% of the world's foreign central bank foreign reserves was in the dollar. Now it's about 57%. That's an enormous decline, but it's over 30 years.
Mm-hmm.
Right now, it's stepped up in the last few years, but these things take time. But the same sort of numbers apply to global trade in the dollar. So I hear some people will push back and say, oh, all this stuff you're talking about, replacement of the dollar, is nonsense, it's nonsense. The dollar is still the dominant currency. Yes, it is still the dominant currency, but that dominance is getting less and less as time goes on. And I am reminded of that overused phrase of Hemingway's about how you go bankrupt, slowly at first and then suddenly. When you see less than 50% of the world's trade in the dollar, things will unravel very quickly, I think. But we're not there yet. It's going to take time. And you have to have an established replacement, right? Before one currency loses its reserve
Right.
currency status, you have to have an established replacement, which we don't have at the moment. So yeah, so it's going to take time, but it is coming, and
Yeah,
that's all positive.
yeah, we have seen this leak that's come out from the BRICS side where they plan on creating a 40% backing to gold for their settlement currency. Well, I mean, what would that do for the dollar? Like a quasi gold standard. What does that imply for the dollar? Would that completely annihilate the dollar?
Well, annihilate is a strong word. I don't think it'll annihilate it in the same way that when the British pound went off the gold standard and was replaced by the dollar, that didn't annihilate the pound. It was pretty dramatic, I can tell you. We went from the pound being worth 5 to 1 to the dollar down to virtually 1 to 1. Took 40 years to happen. We had a very weak economy. We had in the 60s Britain actually going to the IMF, cap in hand for a loan. I mean, can you imagine? We used to be the world's strongest economy, strongest military power, strongest political power. So that's a scenario I can easily see duplicated for the dollar. But again, it's going to take time. We're not there yet. And before we get there, you have to have that replacement in place.
Mm-hmm.
With Britain, Britain was still the world's leading economic, military, and political power in the 1920s and 30s. It was losing some of that dominance as the US replaced. But when the Second World War happened, it was very, very, very obvious that the US had now replaced Britain in all of those areas I mentioned, political, military, and economic, especially with the harsh terms that were put on the loans that America made to Britain. We thank you very much for it because you saved our backsides, but they were harsh terms. And in 1945, it was obvious to anyone that wanted to think about it for a second that Britain had lost that dominance, the pound had lost the reserve status. But equally important, it was very clear to everyone that the dollar was now taking over. When we don't have an obvious replacement at the moment. And until we do, the dollar will still remain dominant.
A point that often is made by the likes of previous guests that I've had on the show, like Doug Casey and Rick Rule, is that sure, you have this BRICS alliance between Russia and China and India and so forth, but as much as they don't trust the United States and the dollar, they trust each other even less.
Sure, but when you've got a strong enemy, it can make people come together.
Mm.
And if Russia and China, which they do, view the US as the enemy, Russia and China, who are not natural allies by any means, we've seen how over the last 10 years they have clearly started to work together. We've now seen India and China, who remember had a hot war.
Mm-hmm.
Was it 10 years ago, 12
Yeah.
years ago? I forget now. Time flies when you're having fun. But they had a hot war with people killed, and this is two nuclear powers. They sat down in Russia to try to work out their differences. So when you've got, it's just like when you're on the schoolyard, right? You may not like the guy, the bully, but when there's a bigger bully, well, let's team up with this guy and see if we can defeat the big bully. So, I agree. Obviously, I respect Doug and Rick tremendously. And what they say is true. All these countries have different objectives, different views, different ways of doing
dynamic.
things.
It's dynamic to the environment.
Yeah. Yeah.
So sticking on the geopolitical front, or let's call it the political front in this case, we do have an election coming up in a few days, for better or for worse. And I'd be remiss to not mention it. What impact should the average investor, the average gold and silver stacker, what what impact could either outcome have on the markets, on gold, on silver, etc.?
Yeah. Um, so before we get 101 or 1,001 angry emails, I'll just say this is an analysis, not a political, not a political. It's not my view of what I would like to happen. So first of all, I don't think either outcome, and it's looking increasingly certain that it's going to be one outcome rather than the other. But I don't think either outcome is going to have any impact on gold or silver because, look, let's face it, neither side is going to fix the deficit. We are still going to have very high debt levels in the US, which means we're still going to have very high debt service obligations that are now the largest single component of the US budget, is simply servicing the debt. So that's the fundamental thing. And if you've got those very, very high debt levels, the Fed will continue to lower rates with or without any quote interference from the administration. Rates will be continuing to come down. Similarly, whoever wins, I don't think inflation is going to, I don't think we can say that if one side wins, inflation is going to suddenly go down. Mm-hmm. So, high debt, lower interest rates, stubborn inflation, that the scenario, at least for the next 12 months, is going to be pretty similar for gold and silver, whoever wins. The bigger differences will come on the economy generally and on some of the other resources. So Trump, for example, has made several times, he said, drill, baby, drill. And even though we have a high oil and gas production in the US at the moment, there are significant constraints in terms of permitting, significant constraints to new fields opening up and to new production. So I think a Trump victory would likely ease those restrictions, would get new drilling. Some of it might take a couple of years before we get the oil, but we'll see things open up. That will be positive for the oil and gas companies, but it will be on the negative side for oil and gas prices. Obviously, if you produce more, other things being equal, the price goes down. I mean, I'm not overly worried about the prices collapsing, but certainly it will stop them going up more than they otherwise would. But on other things, we're likely to see an easing in other resources, an easing of permitting restrictions. So that will certainly help specific companies with specific projects. I think of some of the copper in Arizona, for example, but very little impact, I would think, on the prices of the commodities themselves, which are global markets. There are other factors that are much more important. China's economy is obviously much more important to the price of copper than whether this project or that project gets a permit in Arizona. So it'll be helpful for the companies, but not much impact on the commodity price.
Interesting. Before we wrap up, I want to get your thoughts on what you see going on here with the decoupling of the yield curve versus the Fed interest rate, Fed funds rate.
Yeah. Yeah. I mean, you're not seeing the changes at the short end, which makes sense because the Fed's influence is always strongest over the short end, right? And particularly at the Fed funds rate, which is the shortest rate of all. So 1 month, 2 months, 3 months have not been affected. But, think about it further out. If you're an investor, longer term rates are set by the market, not by the Fed. I mean, if you're an investor, would you want to buy a 10-year treasury, let alone a 30-year at 4.5%? I wouldn't. That's not an investment to me. That's a
Guaranteed
guaranteed
loss.
loss.
Yeah.
As I think it's Jim Grant who calls them return-free risk. Uh, so that's a guaranteed. Who was it who used to call them guaranteed certificates of confiscation? Oh my gosh,
I've heard it
that's
before. I don't know who it is
yeah,
though.
that's from the 80s or 90s, and the gentleman, the name will come to me, but he's deceased now. But anyway, but the point is, no one's going to invest money in a 30-year treasury at 4.5%. The market is demanding higher returns, even at the same time as foreign buyers are retreating from our market. So the traditional main foreign buyers, Russia, Japan, and China, are all reducing their holdings. Russia, of course, has already sold. China is actually a net seller, has been for a while now. Japan has been a net buyer, but that is slowly turning again at the margin, but prices are set at the margin. That is slowly turning as interest rates in Japan move up, which will strengthen the dollar and it'll the yen, I mean, strengthen the yen and will reduce the differential between US rates and Japanese rates. US rates will still be much higher. So a 30-year US bond will still pay a lot more than a Japanese 30-year bond, but that differential will narrow. And at the same time as it's narrowing, the yen, let's just say the certainty that the yen will decline, which makes your carry trade work, is not so obvious anymore. And so those things will get Japanese investors to sell some of their US treasuries and to invest in Japanese in JGBs. Again, at the margin, I'm not saying they're suddenly all going to stop buying, but with the three largest foreign buyers now no longer adding to their positions, right? You're left now with US institutions like insurance companies and pension funds that need those long-term returns. But at 4.5% for an insurance company, 4.5% over a pension fund is not sufficient, for what they need for their obligations. And you're left with, hedge funds and traders. And traders are going to want more. I mean, so rates have to go up at the long end. I mean, we're buying for our clients, we've got a lot of 1 and 3 month T-bills. When you can get 5% to park something in cash when you're nervous about the overall stock market, that's not a bad return for a short bit for 1 or 3 months. I wouldn't dream of buying a 30-year bond. I'd probably get fired by my clients if I did.
Fair enough. Well, hey, Adrian, anything else you want to talk about? I think we've covered pretty much everything that I had here on my notes.
No, the only thing I would say to people is if what we're seeing today and what we've seen for the last 3 or 4 days, if we start to see a correction in the gold market, just not to panic on that, not to panic at all. The stocks are still, but everything is still fundamentally favorable for gold. And importantly, it's increasingly favorable for gold. And at the same time, the gold stocks remain incredibly undervalued. So, we just have to be careful that we don't panic on this decline.
Definitely. Well, hey, where can people find you, Adrian?
The website is adrianday.com.
All right.
So,
So we'll have that link, nice and simple. We'll have that link down below in the description box as well as the pinned comment. Be sure to check it out, guys. And also, if you made it towards the end of this video, thank you so much for watching. Thank you, Adrian, for coming on. And give us a like. If you enjoyed this content, if you agreed with what we had to say, write "Go Adrian Go" in the comment section. If you disagreed with anything, let me know what you disagreed with. I do read the comments, although I may not respond to each and every one of them. I do indeed read them, and they do influence my decisions down the road when it comes to this channel. And yeah, it's been a pleasure, guys. Also, check out our Substack, capitalcosm.substack.com. We'll have the link to that below as well. You can support me through there if you choose to. And with all that said, I'd like to thank you again for your time, and I'll catch you in the next episode. Bye, guys.
And thank you, Danny.